morning from cloudy and cool Chicago, home of the first place Chicago White Sox. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today is Sunday, July 26, 2026. Since our previous Following the Money podcast, which was exactly 2 weeks ago, the financial markets have become noticeably more cautious as institutional investors rotated away from the high growth sectors that have driven the bull market for much of the year and into more defensive areas of the market. This shift reflects growing concerns that elevated interest rates and persistent inflation will continue to pressure equity valuations, even as the broader economy remains on pretty solid footing. Beneath the surface, weakening market internals, rising volatility, and the loss of leadership from semiconductors and also from big cap technology suggest investor confidence has become increasingly selective and that the market's underlying foundation is starting to soften. Despite these developments, longer-term trends remain constructive, with stocks continuing to outperform bonds and economically sensitive mid-cap stocks holding up relatively well, indicating the current weakness is more consistent with an intermediate-term correction within an ongoing economic expansion than the beginning of a recession-driven bear market. Unless market leadership broadens and risk appetite starts to reemerge, however, the evidence suggests investors should expect a more defensive market environment over the next few weeks while monitoring for signs that the broader bull market can regain its footing. Next thing we're going to do is we're going to get into more details by looking at some of the charts and data surrounding some of the key forces driving the markets that I just talked about. We'll look at some of our own models, and we'll look at a number of different data series that just kind of back up what I just said. Before we do that, though, let me take a minute or two to tell you a little bit about Asbury Research and what we do. Asbury Research is a registered investment advisor. We are an RIA. I launched Asbury Research in 2005 after spending 25 years in the business, most of it on the trading floor of the Chicago Mercantile Exchange in the 1980s and 1990s, which I call my extended college education. What we learned to do is build a number of different models and techniques. One of them we call intelligent diversification, which is an actively managed approach that we designed to constantly adapt to changing market conditions rather than trying to rely on the traditional static set it and forget it allocation models, which if you ever work for an advisor, there's a good time that you were using some kind of a variation of this, and they just don't work anymore. There are two ways to access Asbury Research. One, by subscribing to our research products, or two, investing in our managed portfolios. For those who like research, do-it-yourselfers, Asbury offers both its flagship Asbury Premium Research Service and also a low-cost entry-level Substack newsletter. We're going to take a closer look at the Substack towards the end of the podcast here today. Everything else that you see that we're going to talk about in just a minute come from the premium service. For those who prefer a managed account, we have created 5 model portfolios using our own models, including the correction protection model, or CPM, which is a risk on and risk off model, and also our CEF model, which is a sector rotation model, and we use these as building blocks. These model portfolios have undergone extensive backtesting over the past 8 years and have been trading in real time for 2 years. Year to date, our cornerstone CPM tactical allocation model and CEF sector rotation model are both within about 1% to 2% of the S&P 500 through the end of last week, but with better defensive numbers, including smaller drawdowns, lower standard deviation, which means more consistent returns over time, and lower betas, which means less volatility than the S&P 500. Full disclosure, all of my own money that goes into equities is strictly going into all of our models. I don't do personally any other equity investing other than to track our own models. Now let's get to some of the reasons that you're here, and we're going to look at some charts data and some of our own models. Let's start by going over to the Research Center. This is the paywall. And we're going to scroll down here and we're going to get to the Asbury 6. Whenever I'm on the Schwab network, whenever I'm really getting interviewed anywhere, we've kind of become known for the Asbury 6. The Asbury 6 is a daily data-driven gauge of the U.S. stock market's real internal health according to 6 diverse metrics that we selected using quantitative backtesting. The reason we built the Asbury 6, probably the first version was about 10 years ago, was because it became increasingly difficult to try to determine the general health of the market by looking at the S&P and a couple of canned indicators like a MACD or an RSI or maybe a moving average. Too much volatility. Market's up 50 today, down 70 tomorrow. And even as a veteran of doing this, I was getting kind of spooked out of really good ideas because we had 1 or 2 days of volatility. And then I end up going back into my idea, but I have to pay up for it. So we started taking all of the tactical tools that I've had success with over my career, including when I was on the trading floor, and we started to test them together in groups of 4, groups of 6, to try to find something that just wasn't going to chase the tail of the S&P 500. So we ended up with these 6. They work real well together in the sense that no indicator works all the time. Everybody asks you, what's your favorite indicator? I don't have one because there is no indicator that I've ever come across that is something that works all the time and I can throw everything else away. I wish it was that simple, but it's not. So we came up with these 6. We've got the rate of change in the S&P 500, relative performance of stocks versus high yield bond prices, investor asset flows, volatility, trading volume, and market breadth. 4 or more of these in one direction indicate a directional bias for the model itself. So it had been 4 or more green since July the 1st. As of July the 23rd, which was Friday, it was 2 days ago, you could see 4 of these are now red. That turns the model itself to a bearish bias and indicates that the market is internally weak. Over the years, with an 8-year look back, the A6 has underperformed the S&P slightly by about 2% annualized, again, over the past 8 years, but the maximum drawdown in the A6 has been 11.5%. It was 34% in the S&P 500. So again, I use this not really as a model to trade, but as an indicator every day of, is the market strong enough to keep going higher, or have the internals started to fall apart enough to where we can expect a correction? Right now, through Friday, the A6 is telling us the market is internally weak and vulnerable to a correction or a move lower. A6 is part of our premium research subscription. So now we know the market's internally weak heading into next week. Let's take a look at some sectors via our CEF model. So we're back to the research center. And here's CEF. And there we go. Let's get down to the graphic. And the CEF model is for alpha generating sector rotation. The CEF model is a completely data-driven sector rotation model. It was created to quantitatively identify long/overweight opportunities in U.S. market sectors by, rather than focusing on the relative performance, trying to get ahead of that game a little bit by following the money as it moves around these 11 sectors. These 11 sectors together are the S&P 500. So here's how it works. 3 different time frames. We have a trading week, we have a tactical month, and we have a strategic quarter. The fastest money in any one of these time frames is designated with a green number 1, a green cell and a number 1. The fastest money coming out in that time frame is a red number 11. So what we got here last week, fastest money moving in was going into financials in the trading week. Fastest money moving out over the past week was coming out of tech. In fact, look at this. Tech's been leading the market higher for much of the year. But look where it is now. The fastest money running out of tech is going into out of tech is it's leaving tech in the trading and in the tactical. It's number 11. That means the fastest money moving out in the first two time frames, weekly and monthly, coming out of technology. Note communication services. Money is quickly coming out in a little longer term time span in the tactical month and also in the strategic quarter. Look what's going on up top. Financials is number 1 in trading, number 1 in tactical, number 2 in strategic. That means right now the money is moving into financials the fastest. This changes as market opinion changes, but this is coinciding with the highest long-term interest rates in the treasury market, in the 10 and the 30-year treasuries that we've seen in some time. Also, healthcare here, 5, 2, and 4. So those are our top 2. The way we trade the model as a part of our model portfolio is we're always in the top 3. Why not just the top 1, John? Because sometimes the one where the money is going into the fastest may not be the one that's performing the best because there's other inputs just besides asset flows. Asset flows is a really important one. I would argue that it might be the most important over time, but you've got interest rates. You've got news coming out of the White House. You have global politics. You have earnings. There's all these different influences that push these things around. So the way that we trade this is it's always fully invested in the market, providing investors with a dynamic market conditions generated alternative to the traditional buy and hold portion of your portfolio. Year to date, CEF is trailing S&P 500 by less than 1%, but with a 38% lower maximum drawdown. We are really advocates of keeping drawdowns lower, especially for older investors. Since inception, CEF has outperformed the S&P 500 by 6.5% on an annualized basis, with a 13% lower maximum drawdown and 27% lower standard deviation and 51% higher Sharpe ratio, which means better risk-adjusted returns. Next thing we're going to do is look at some of these charts just so you understand what we're doing. So we're going to scroll down, and the corresponding charts for the CEF model are called rainbow charts. And as the name suggests, they look like a rainbow. This is financials. Financials is currently number 1 ranking. So what we have here is the daily change in the CEF model going back 12 months. So this is a 12-month span here. Favored is green, neutral is yellow, and avoid is red. So, and down here, this is the relative performance. This is a corresponding relative performance chart between XLF and SPY. So you can see here, roughly, early to middle of June, it moved into favored financials moved to favored status. They backed up just a little bit towards the beginning of July, but now look where they are. Favored is high, is low actually, because the lower the number, the better the score. It's like golf. But you can see this is the strongest favored status signal that we've had in a year. Let's look at one more. Let's look at, because this is a little nuance of the data. This is healthcare. Healthcare is currently ranked number 2, but look what it's been doing. It's been seesawing from being in a void where everyone's wanting to get rid of it, to going into favored, back to a void, back to favored, back to neutral, and back to favored. It looks like somebody having a heart attack. What's going on here, while this is moving back and forth, the other side of that is technology. And why is that? Because people really don't know what to do here. Investors, managers who primarily use these ETFs, they're getting mixed messages every other week. The war's over. The war's not over. Tariffs are over. Tariffs are not over. We have to give the money back for tariffs. There's constant noise coming out of the White House, coming out of geopolitics where these guys really don't know what's going on. Half the year is gone, and I think generally people are having a tough time this year because of all of the internal tumult that's going on in the world. So as healthcare is moving up to the top of the safe ranking system one week, and everybody sells technology. So defense, healthcare, offense, technology. Then the following week, it flips the other way. So every time that you see healthcare up here, if I showed you the other chart, you see technology down here. So that's what's going on under the hood. There's a lot of, the markets can handle bad news just fine. They don't do well with indecision. And there is more indecision right now coming out of multiple places than I can recall seeing. The next thing we're going to do is go to one of our standard weekly reports because there's some pretty cool charts in there that I want to share with you. This particular report is called Keys to This Week, and this was just published on Friday, so these charts are pretty fresh. Risk appetite is fading. Let's look at the S&P 500. I mentioned that the market really isn't sure what to do here. Well, you can see this is the middle. This is the middle of May, right here. We are the S&P 500 has effectively been moving sideways since the middle of May, a couple of months, because again we've had a really nice run here from the late March lows. The market got to June 2nd, and investors kind of collectively said, "Wait a minute, I think we might be over our skis here a little bit." And in the meantime, again, you're getting all this mixed messaging. We got now people are looking at the polls because we're pretty close to an election. So there's a lot of indecision going on, and that shows itself here. The S&P tried to break out here at the end of June. You could see it failed, and now we fell to the bottom of this kind of coiling triangular pattern. If we get through 73.94 early next week, next stop is 72.38, and I would not be a bit surprised to see us go down to 7,000 in the S&P, and that would be a value area should that occur, and we would be watching really closely, maybe for an opportunity to buy the S&P back at a much better price. This is another indication of what's going on. Sometimes you look at the S&P 500 and you're like, what's going on here? It's flat. There's no indication of direction. We are big advocates of looking at relative performance. This is the SOX index here. This is the Phillips Semiconductor Index. It has been leading the S&P 500 higher since May of last year. Look what's happened of late. This is SOX versus SPY down at the bottom. And this is a 63-day moving average. Why 63 days, John? Because that's a business quarter, and that's the strategic time frame that we're trying to capture. So this chart goes back further. I wanted to not go all the way back to May of last year because everything gets too small and you can't see. So this actually started January. Look what's happened since July 15th. SOX is now underperforming the S&P 500 on a 63-day quarterly strategic basis. That's not good. It means we lost our leadership from the SOX. Next chart. This is NDX. This is big cap tech. This has been outperforming since April the 8th here. Look what's happened. Since July the 13th, it's now underperforming. So we've not only lost semis, but we lost big cap tech. Those are typically the two primary leaders in a healthy bull market. We've lost them. Notice even that the NDX is now underneath its 50-day moving average up here on top on an outright basis. Next, small cap's been outperforming. It's been a little bit more erratically outperforming, but outperforming nevertheless. Look where IWM, which is the ETF that tracks the Russell 2000, is. It's been outperforming on a quarterly basis since May the 22nd, but it's testing that trend. It finished the week right on top of this trend line. If we lose small cap, again, which is a secondary driver, I think, after semis and after big cap tech, we lost another leader. So we're going to be watching small cap really closely. Note that it's sitting on its 50-day moving average, IWM is. So we've lost semis, we've lost big cap tech. We may be losing small cap. It's too early to say. This chart is very interesting to me. This SCHD is the Schwab U.S. Dividend Equity ETF. All of these ETFs always have to have a nine-word name, it seems these days, but that's what this is. This is showing dividend stocks, and what I've done down here is I made a relative performance chart in the lower panel that checks the relative performance of dividend stocks versus growth stocks. We use SPY-G for that. So in December, dividend stocks started outperforming growth stocks on a quarterly basis up until April the 10th. What happened during that period? The S&P stopped going up and started moving downward. April 10th is when we actually bottomed on March the 30th. But you can see by April the 10th, dividend stocks were underperforming growth stocks. That was more evidence that risk appetite had gotten better, had gotten stronger. Look what's happened now, though. Since July the 16th, you've got dividend stocks outperforming again. So even though the S&P is still within that range that we looked at up here, really hasn't broken out or anything yet, looking at what the condition of the market is via relative performance, the market is gravitating into more defensive places. I don't have it here, but the Dow has been outperforming the S&P 500 for 2 months. That's another typically defensive relationship that you would see when the market's kind of pulling in its horns and going into the turtle because it's afraid it's going to have a correction or it's going to start to move lower. Last thing, let's take a quick look at our Substack entry-level product. Oftentimes, people will sign up with us for the premium product, which is $499 a quarter. And they'll just find that it's too expensive for them, or they're just not ready. So we made a Substack. Here's our Substack. It's called Chart Focus, and we have a lot of other stuff in there that we put in. I was interviewed on IBD last week, so that interview is there. There are basically 3 different components in the Substack. They are Chart Focus, which looks a lot like the keys to this week that I just showed you. It's a lot of charts, it's a lot of analysis, a lot of granular explanation on why the market's doing what it's doing. Our sort report, and then we have some rainbow charts too, which is what I already showed you. Let's look at the sort report, and let me explain what that is. It's actually right up top here. Well, let's look here. Let's make this bigger. What we did is we created a quantitative scanning system, let's call it. We scan a lot of markets every day. I have 6,600 ETFs, I think, at 5 o'clock in the morning. What we did is we picked a broad array of those. We have, they're all ETFs. We have crude oil, commodities, U.S. gold, U.S. dollar rather, gold, crypto, global equities, ex-U.S., emerging markets, small cap technology, and interest rates. And now we rank them according to positive trend, relative performance versus whatever their benchmark might be, and asset flows into that particular ETF, which is the fuel that drives an uptrend. Right now, we have 2 that are green all the way across. They're checking all the boxes, so to speak. We have crude oil, and we also have commodities. So what's this for? When you're a subscriber and you're looking at this, or you're getting up in the morning and saying, where should I be looking for opportunities? This is a very quick, mathematically driven way to tell you crude oil is positive trend. It's outperforming its benchmark, and there's fresh money coming in there in an aggressive way. The same with commodities. So instead of looking at 500 charts, you can start to focus your look here, because we know quantitatively these are good places to look for opportunity. You can view there's a video in here, by the way, too, that explains how to look at the rainbow charts. And we also have a free version. Let's back out of here. We also have a free version of the Substack. So if you go to asburyresearch.substack.com, you could sign up for free, and you get I think you get 3 different pieces of research, 2 or 3 different pieces of research for free. And then if you have the paid version, it's $25 a month, and you get a whole lot more. You're getting much more information and much more in-depth analysis of these markets. So there we go. That wraps up today's Asbury Research Following the Money podcast. Next one's tentatively scheduled 2 weeks from today on Sunday, August the 9th. I hope to see you again there. I will be presenting to Fidelity Investments for my 10th or 11th year in a row. We do a mid-year outlook. It's about an hour long, and it's free. So if you go to Fidelity on the internet and go to events, if you'd like to participate in this, it's free of charge. And again, I was interviewed last week on IBD. You can go to IBD and you can find that video. That was another hour. I've been getting a lot of FaceTime in the media lately. Our focus here at the YouTube channel is to give you a realistic, data-driven, no BS, practical look at the financial markets and investing from a guy that's been doing this for most of his life. There's a lot of showbiz in the markets, in the financial world. There's a lot of hype, and there's just a lot of stuff to sift through. I've been sifting for 40 years. After a while, we started to build our own metrics and models to pay attention to what we think are the most real and relevant things, rather than focusing on the canned indicators that you can get for free on the internet, the stochastics. And they all have their place. I'm not discounting them, but for us, creating our own metrics that are focusing more on relative performance and asset flows has become a lot more lucrative for us. It just gives us better trading ideas. Everything we do is based on data. If we have an idea, we backtest it for 5 to 8 years before we even think about integrating it into what we produce for our subscribers and putting it into our model portfolios. And our models are focused on defense first, which most people don't do that. How big the drawdowns are versus the S&P, how volatile your account is versus the market, and what the risk-adjusted returns look like so you can sleep at night. Because the stock market inherently goes up over time, we don't need to take excessive risks, or we don't need to try to make a fortune in 1 week. The secret of winning this game is staying in the game, and you do that with low drawdowns. If you have any questions about what we do or want more info on our research subscriptions or managed accounts, you can contact us via the contact tab right here at asburyresearch.com. I'll see you right here again in 2 weeks. Enjoy your Sunday, and don't forget to like and subscribe. Have a great Sunday.